Welcome back to the deep dive. This is where we take all that complex, dense information you send our way and, well, we try to boil it down into some genuine insight. Today, we're really getting into the weeds of corporate transformation. We're looking at the materials you shared on Cognizant Technology Solutions, that's ticker CTSH. And what we've got here is essentially a classic turnaround story unfolding. Our mission really is to look beyond the headlines, the official statements, and find those aha moments, the things that really explain how a huge global IT and professional services firm, one that, let's be honest, seemed a bit stuck for a while compared to some rivals, how they're planning to reshape themselves, engineer a pretty major pivot right into this age of AI. Just for context, Cognizant is, one of those big global names. They do IT management consulting, business process outsourcing, the whole suite. But the real question for us today is, are these changes real? Is there substance behind the strategy, or is it just, shuffling the deck chairs?
That's exactly the core question, isn't it? The difference between just saying you're turning around and actually doing it.
Yeah.
And if we pull back and look at the main investment thesis that comes through in these documents, the big takeaway, the sort of nugget, is that this looks like a credible turnaround story. It doesn't feel like just, wishful thinking or trying to catch a rising tide. The whole thing seems driven by decisive new leadership.
Yeah.
Specifically, CEO Ravi Kumar S, who came on board, when was it? Early 2023.
Yeah, early 23.
Right. And the strategy really boils down to two, let's call them foundational pillars, absolutely essential. First, there's this immediate, pretty aggressive internal cleanup. It's an operational restructuring program they've branded Next Gen. That's the efficiency play, the defense, maybe,
Okay.
stabilizing things.
Pillar one, efficiency.
Exactly. Pillar two is the offense. That's the big forward-looking bet. A massive investment, estimated around $1 billion, into generative AI capabilities. And crucially, this is underpinned by a really important technology partnership with NVIDIA.
$1 billion and NVIDIA. That definitely signals intent. And what's interesting looking through this is that it seems like the market's starting to, well, pay attention. We're seeing some early signs that this isn't just talk.
Precisely. The indicators are starting to line up, suggesting it's translating into actual business results, moving from, a plan on paper to real execution. We're seeing things like organic growth starting to find its feet again, bookings are accelerating, hitting record levels, actually. And operating margins, which had been under pressure for years, seem to be finally stabilizing.
So it's that combination, internal cleanup with next gen, plus the external growth push with AI and NVIDIA.
That's the formula they're banking on, using the efficiency gains from Next Gen to fund the AI push, and hoping that combination closes that profitability gap that's, frankly, dogged them for quite some time compared to their main competitors.
Okay, let's dig into that pivot a bit more then, because the timing here feels really important. Before 2023, it's fair to say Cognizant was lagging, right? Compared to the Accentures, the TCSs, Infosys, they seem to be struggling a bit to keep pace with that really rapid shift towards cloud, towards digital transformation. That's what led to that feeling of stagnation we mentioned.
Undeniably, they were underperforming key peers for several years there.
So when Ravi Kumar S came in, the mandate was pretty clear, but the job was huge. He basically had to pull three big strategic levers all at once to try and turn the ship around. And it looks like the focus quickly zeroed in on three main goals. First, obviously get revenue growing faster overall. Second, become what they call an employer of choice, which in this sector, fighting for talent, that's absolutely critical, isn't it?
Oh, absolutely vital. You can't deliver advanced services without the right people.
And third, really overhaul their internal operations, modernize how they actually work and deliver services.
And that third piece, modernizing operations, that flows directly into this big internal program, Next Gen, kicked off Q2 2023. And it's really important for you, the listener, to grasp that this isn't just your standard quarterly belt tightening. No, this is framed as a much more fundamental effort. They're trying to simplify what sounds like a pretty complex, maybe even bureaucratic operating model that had built up over the years.
Simplify how? What are they actually doing?
Well, it hits a few key areas. They're looking to optimize the central corporate functions, think finance, HR, legal, procurement, get more leverage there. But probably the most visible part, the thing that grabs headlines, is this big realignment of their global real estate.
Right.
Basically shrinking their physical office footprint quite significantly to match the reality of hybrid work, less need for massive buildings everywhere.
And that comes with a price tag. The notes mention $350 million for the restructuring costs running through 2024. Okay, but here's a question. Closing offices saves money, obviously. Consolidating functions, sure. But what about the human side, the culture? If you dramatically shrink office space, does that signal retreat to employees? Or is it seen as, embracing modern flexibility? How do they manage that perception?
That's a really sharp point, and it's definitely a balancing act for management. The way the sources frame it, though, is as a necessary move, partly to attract that younger talent pool that expects, even demands, flexible work options, but also critically, to achieve those necessary cost savings. The material really emphasizes the strategic link here. CFO Jatin Dalal is quoted saying that the improved cost structure from NextGen, that's the financial engine, it's what allows them to actually sustain these big strategic investments like the billion in AI and aim for profitable growth.
Ah, okay. So the savings aren't just savings for savings' sake. They're directly fueling the future bets.
Exactly. Without those, let's call it $350 million in hard-won efficiencies, that huge AI investment starts to look a lot riskier, maybe even reckless. So efficiency is directly enabling capability building. It's discipline.
Cut the fat to fuel the muscle. Classic strategy. And you mentioned we're seeing proof this is working. The sources highlight tangible evidence of better execution in financial services, right? FS, which is a huge deal for them. It's nearly 30% of revenue, 29.1% in fiscal 24. So it's always been a kind of bellwether for the whole company. If FS is sick, Cognizant is sick.
Historically, yeah.
And it was sick. It saw a 1.0% revenue decline in FY24. The reason given was clients cutting back on discretionary projects, as interest rates were climbing and uncertainty was high.
True, but that decline wasn't just the macro environment playing out. CEO Kumar was quite specific, according to the sources. He talked about needing to tackle, and this is his phrase, company-specific issues.
Company-specific, meaning internal problems.
Pretty much. It seems it involved two key things internally. First, stabilizing the leadership within that FS segment. Apparently, there'd been too much churn, too much instability at the top. And second, making sure their actual service offerings were more compelling. Moving beyond just basic IT maintenance into areas clients really cared about, like digital risk management, core banking modernization, things like that.
Okay, they made fixes. But the question is this FS growth we're seeing now sustainable? Or is it just, banks starting to spend again anyway, a rising tide, lifting their boat? How do we separate their actions from just a cyclical bounce?
That's fair. But the evidence suggests it's more than just luck or timing. Look at the speed of the turnaround. The data is pretty stark. By Q1 of 2025, FS didn't just stabilize, it flipped to solid growth, up 6.5% year over year in constant currency.
Wow. Okay. From -1 to plus 6.5 is quite a swing.
It is. And then it even ticked up slightly again the next quarter, Q2 2025, hitting 6.9% year over year growth. That kind of rapid inflection point, especially in a segment that large and previously struggling, strongly suggests the internal changes, the leadership stability, the refreshed offerings, are actually working. They seem to be winning business based on their own improvements, not just riding a wave. The market seems to be rewarding those specific fixes.
Okay, that FS recovery does sound like a solid proof point for improved execution.
Right. And to really grasp the potential here, it helps to understand the underlying structure they're building on. Cognizant uses a pretty standard but effective industry-focused model. They organize everything around deep expertise in specific sectors, tailoring solutions for clients within four main segments. This lets them go beyond being just, generic IT providers. They can act more like specialized industry consultants who also happen to be very good at technology implementation.
Makes sense. So let's quickly run through those segments again just to see where the revenue actually comes from. Based on fiscal year 2024 numbers.
Sure. The mix is deliberately spread out, which gives them some natural resilience. First up, health sciences. HS, that's actually their biggest right now at 30.1% of revenue.
Okay. Healthcare, pharma, insurance, payers.
Exactly. A whole ecosystem. And the focus there is really technical things like digital health platforms, dealing with complex regulations like IPA in the US, modernizing those big old core administrative systems.
Yeah.
Like move claims processing to the cloud. It's driven a lot by regulation and the need for efficiency in very complex processes.
Got it. Then FS, financial services, we just talked about, that was 29.1%.
Right. Banks, insurance, capital markets. And the focus there is stuff like core banking transformation, managing all the risk and compliance mandates that's a constant source of IT spending, and of course, improving digital customer experiences, especially mobile and online.
Okay. Then products and resources, P&R. That's number 3.
P&R is 24.2%. It's a pretty diverse bucket. Includes retail, manufacturing, logistics, energy companies. The big needs there right now. Things like supply chain optimization, huge after the pandemic disruptions, implementing modern ERP systems, and this increasingly important area called engineering, research, and development, or ER&D. We'll come back to that.
All right. And lastly, communications, media, and technology, CMT.
CMT is the smallest at 16.6%. That's helping telcos figure out how to make money from their networks, helping media companies transform their supply chains, basically how content gets made, managed, and pushed out across all the different platforms today.
Okay, that segmentation makes sense. It paints a picture of a diversified business. But let's zoom out again. Why is this whole industry, IT services, growing so fast? Forget Cognizant's internal stuff for a second. What are the big waves lifting, everyone?
Oh, the scale is just massive, and the drivers feel almost irreversible at this point. The overall global IT services market projections put it at something like $1.43 trillion in 2025.
Well, yeah.
And growing to potentially $2.32 trillion by 2032. That's a compound annual growth rate, a CAGR, of about 7.2%. And it's really fueled by fundamentally three unstoppable trends. One, the relentless push for digital transformation across literally every business. Two, the ongoing deepening shift to cloud infrastructure. And three, the ever-increasing need for robust cybersecurity. These aren't optional nice-to-haves anymore. They're basically the cost of entry for doing business now.
But hang on, here's where it gets really interesting looking at the numbers, because there's one specific catalyst within that growth that just blows everything else away, and that's artificial intelligence, AI. The forecasts for the AI market itself are just staggering. We're talking a potential 36% CAGR, expanding to possibly over $1.8 trillion by 2030.
It's astronomical growth.
Right. So when you see that number, 36% CAGR for AI, and you put it next to Cognizant's past struggles and their big strategic pivot, it becomes crystal clear why management decided to bet $1 billion specifically on AI capabilities. They're consciously trying to pivot away from some of the slower growing, maybe lower margin legacy stuff, and plant their flags squarely in the middle of what looks like the single biggest economic growth driver for the next decade.
Absolutely. It's a strategic realignment towards the biggest wave. And crucially, success in riding that wave depends heavily on partnerships. The competitive reality is you have to be deeply integrated with the big three cloud providers, Amazon's AWS, Microsoft Azure, and Google Cloud Platform, GCP.
The hyperscalers.
Exactly. Together, they dominate. They command well over 60% of the cloud infrastructure market. So any major enterprise IT project today, whether it's a digital transformation or deploying AI at scale, it absolutely requires deep, constant technical collaboration with those providers. It's basically a ticket to play.
Right.
Cognizant needs those strong partnerships to even be in the running for the big, complex deals.
Which sets the stage perfectly for digging into the core of their growth strategy, that billion-dollar AI bet, which seems to be embodied in this thing called the Cognizant Neuro AI platform.
That's right. And the whole idea behind Neuro AI, the philosophy, isn't just about offering some AI consulting on the side. It's designed to tackle what they see as the biggest hurdle for enterprises right now, which is how to move beyond just playing around with AI, doing little experiments, and actually get it deployed reliably at scale in production, industrializing AI, essentially.
Okay, industrializing AI. Sounds good.
They want to be the firm that helps companies ensure AI actually delivers a measurable return on investment, not just, cool demos that never go anywhere.
But what is the Neuro AI platform specifically? Is it just a new brand slapped on existing services, or are there genuinely distinct parts to it? What are they actually selling here?
No, the sources describe it as a pretty comprehensive full-stack offering. It seems to have three main components designed to cover the whole AI lifecycle, from deciding what to do with AI to building it to keeping it running. First, there's Neuro AI decisioning. This part is focused on, high-value business decisions. It uses generative AI and something called multi-agent orchestration, basically, getting different specialized AI tools to work together to build sophisticated decision-making models.
Okay, give me an example.
So imagine a bank using it to automate parts of its complex credit approval process. It could dynamically adjust risk factors based on real-time market data, maybe without needing a human to manually intervene every time. High-value automation.
Right. Automating complex thinking, not just repetitive tasks. Got it. What about the building part?
That's the second component, Neuro AI engineering. This is described as a full-stack engineering environment. The goal here is to speed up innovation and cut down the time it takes to actually build and deploy AI solutions. It offers things like pre-built AI components, tools for governance, which is huge for AI, and clear data pipelines. Think of it like an assembly line, but optimized specifically for producing reliable AI applications faster.
Okay, an AI factory floor. Makes sense. And the third part?
The third part focuses on the operational side, the running costs, neuro IT operations. This uses AI-driven automation to watch over IP systems, predict problems before they happen, and even automatically fix issues. The goal is twofold: make the client's IT much more resilient, less prone to outages, and at the same time, lower their long-term operating costs by reducing the need for manual intervention and troubleshooting.
Okay, decisioning, engineering, operations, that sounds like a pretty coherent end-to-end approach, but any serious AI, especially Gen AI, needs massive computing power, right? The actual hardware and low-level software.
Totally.
Which brings us back to that NVIDIA partnership. This feels like the absolute linchpin. And I like this engine versus vehicle analogy you mentioned earlier. Can you unpack that?
Yeah, I think it clarifies things well. If Cognizant, with its industry knowledge, is building the specialized vehicle, say the custom AI solution tailored for a healthcare provider or a specific banking process, then NVIDIA provides the incredibly powerful, scalable engine underneath. They bring the whole stack of enterprise-grade AI infrastructure. That includes things like their NIM microservices for deploying AI models quickly and safely, the NEMO platform for customizing those huge foundation models, Omniverse for creating industrial digital twins, Rapids for speeding up complex data science work.
So Cognizant doesn't have to build the fundamental engine.
Exactly. That's the key advantage. They don't need to spend years and billions trying to develop their own large language models from scratch or design their own AI chips. They leverage NVIDIA's cutting-edge tech. Cognizant then focuses on its core strength, building that specialized vehicle around the NVIDIA engine. They add the deep consulting, the regulatory know-how for specific industries, the integration services, that crucial last mile of domain expertise needed to actually make these powerful AI tools work within, say, a factory's control system or a bank's trading platform.
It's like NVIDIA provides the raw horsepower, Cognizant builds the tailored race car, and provides the expert driver.
That's a great way to put it. And that approach is efficient, it's scalable, and it's actually quite hard for more generalist competitors to copy because it requires both the tech partnership and that deep industry knowledge.
And it seems like clients are responding. The numbers on Gen AI engagement look pretty dramatic.
They really do. The sources show the number of active Gen AI client engagements jumping sharply. It went from about 1,400 in Q1 of 2025 to over 2,500 in Q2 2025.
Wow, that's almost double in just one quarter.
It's a significant leap.
Yeah.
It strongly suggests there's immediate, real client demand for this combined capability, the NVIDIA tech plus Cognizant's industry expertise.
Okay, so internal AI platform, crucial NVIDIA partnership. But that's not all. They're also using M&A acquisitions,
Yeah.
right, as another way to boost growth.
Yes, and it seems quite targeted. The M&A strategy described isn't about just getting bigger for the sake of it. It looks like it's focused on acquiring very specific high-demand capabilities or strategically shifting their overall revenue mix towards faster-growing, maybe less cyclical areas.
Okay, let's look at the two big ones from 2024 mentioned in the materials. First, Belkin. What was the goal there? It mentions engineering, research and development, ER&D.
Right. Acquiring Belkin gave Cognizant immediate, significant scale in this ER&D market. This involves providing sophisticated engineering services, often for complex industries like aerospace, defense, automotive, industrial equipment.
Why is that so important strategically?
Because it helps diversify Cognizant's revenue away from its historical heavy reliance on, let's say, more traditional corporate IT spending, which can be quite cyclical, especially the kind of spending you see in their financial services or CMT segments. ER&D work, particularly in areas like defense or aerospace, tends to be longer-term, stickier, and less sensitive to short-term economic wobbles. So it adds a layer of stability to their overall revenue profile.
Okay, so Belkin, diversification, and access to the high-growth ER&D market. What about the second one, Thirdera? This looks like a different kind of play.
Absolutely. Thirdera is a classic and, frankly, very smart platform play. Acquiring Thirdera instantly made Cognizant one of the world's largest partners for ServiceNow.
And ServiceNow is?
ServiceNow is a huge and rapidly growing enterprise software platform. It's basically become the backbone for automating workflows, managing IT operations, HR service delivery, customer service, kind of the digital plumbing for modern enterprise. So by buying a top ServiceNow partner like Thirdera, Cognizant essentially hitches a significant part of its future consulting and implementation business directly to the continued success and expansion of that ServiceNow platform. They capture a slice of the huge growth happening within that ecosystem. It's a platform lock-in a good way.
Makes sense. So you've got the internal cleanup via NextGen, the big organic growth bet on AI with Neuro and NVIDIA, and then these targeted acquisitions like Belkin and Thirdera adding specific capabilities and market access. All of this should theoretically translate into winning bigger deals, right? That's often a key leading indicator. Are clients signing on the dotted line for large multi-year contracts? Because that signals real confidence.
That's exactly what the data seems to show. Large deal momentum is presented as a crucial proof point.
Yeah.
Their trailing 12-month bookings hit a record $27.8 billion in Q2 2025.
Okay, what does that mean in practical terms?
Well, it results in a book-to-bill ratio of 1.4x, which means for every dollar of revenue they recognized in that period, they secured $1.40 in new contracts for future revenue. That's a strong forward indicator.
A healthy pipeline.
A very healthy pipeline. And remember, those leadership changes and offering improvements in FS we talked about, the large deal numbers seem to confirm that turnaround too. These really big deals, the mega deals, valued at over $100 million in total contract value. Clients don't sign those unless they really trust the delivery team and the long-term strategy. Cognizant signed 19 of those in just the first 3 quarters of 2024.
And how does that compare?
Well, that already beat the total for all of 2023, which was 17. And Q2 of 2025 was apparently exceptionally strong. They signed 6 large deals just in that quarter, including 2 that were valued at over $1 billion each.
$1 billion each. Okay, that kind of scale is definitely external validation that something significant is changing under the new leadership.
It certainly suggests a renewed level of client confidence in their capabilities and direction.
All right, so the strategy seems sound. The execution is showing early positive signs. What about the financial bedrock? Can they actually afford all of this? You mentioned the next-gen cost, the $1 billion for AI.
That's where the balance sheet comes in. And looking at the numbers provided, their financial foundation looks remarkably solid, actually quite conservative.
How so?
Well, as of March 2025, they reported having almost $2 billion in cash, $1.9 billion to be precise, versus only $600 million in debt. That leaves them with a net cash position of nearly $1.4 billion.
So more cash than debt.
Significantly more. And their debt-to-equity ratio is incredibly low, just 3.9%. This strong balance sheet does 2 things. It gives them a cushion against any economic downturns, but it also provides the firepower, the war chest, to keep making strategic moves like the Belkin and Thirdera acquisitions without putting financial strain on the core business.
And they're good at generating cash, too. Right, not just having it sit there.
Extremely good. They're described as an exceptionally efficient cash flow machine. They generated $1.8 billion in free cash flow, FCF, in 2024. But the key metric isn't just the absolute number, it's a conversion rate.
Meaning how much profit turns into actual cash.
Exactly. Over the last 3 years, they've maintained a healthy average FCF conversion rate of around 69% of EBIT, earnings before income and taxes. That means they're very effectively turning operating profits into real spendable cash. That's a strong sign of operational health, even compared to specialized tech firms.
And that confidence in cash generation seems to be flowing through to how they treat shareholders.
It certainly looks that way. The management team made a pretty bold statement of confidence by significantly increasing the amount of capital they plan to return to shareholders through dividends and share buybacks. For 2025, the plan is to return approximately $2 billion.
$2 billion back to shareholders.
Yeah. That's a huge commitment. It signals management is very confident that the next-gen savings will stick and the AI growth will materialize, allowing them to generate enough cash to sustain that level of return.
Right.
They're essentially betting heavily on their own turnaround plan succeeding.
Okay, solid financials. But let's talk about the competitive landscape again, because this is where things get fascinating. You mentioned that profitability gap earlier. The next-gen program is specifically designed to tackle that, right? There's this clear pecking order in IT services margins.
There really is. It's quite distinct.
At the top, you've got the big Indian heritage firms, TCS, Infosys. Their operating margins are often up in the, low to mid-20s. TCS around 24.3%, Infosys maybe 21.1%.
That's the typical range, yes.
Yeah.
Very high efficiency, leveraging their scale and delivery model.
Then you have the sort of global consulting giants like Accenture. They're maybe in the middle tier profitability-wise, around 16.8% operating margin.
Correct. Strong, but structurally different from the Indian pure plays.
And Cognizant, currently they're sitting below that, around 15.6% on a trailing 12-month basis. So that gap, especially to Accenture, is what NextGen is trying to close.
Precisely. NextGen isn't just about cost savings in isolation. It's a direct strategic effort to address that historical margin deficit. You see, historically, a lot of Cognizant's business was focused on large-scale, but often lower-margin, application development and maintenance work. Accenture, by contrast, has always had a much heavier mix towards very high-value, high-margin strategic consulting engagements. That structurally supports their higher overall margin profile.
So Cognizant needs to do two things: cut costs through NextGen and shift its revenue mix towards more profitable work, like the AI consulting and implementation.
Exactly. They need to land more of that higher value work associated with things like the Neuro AI platform, while simultaneously getting more efficient operationally through NextGen. That's the path to closing the margin gap with firms like Accenture.
Okay, that margin improvement is clearly critical. But let's circle back to the growth numbers for a second, because there's an important nuance here. You mentioned the reported growth looks okay, around 6.34% TTM, but that number is heavily influenced by an acquisition, right?
That's absolutely right, and it's crucial not to overlook that. The sources are clear. The Belkin acquisition alone added about 400 basis points, or 4 full percentage points, to Cognizant's reported revenue growth in Q2 2025.
So if you strip that out, what's the underlying organic growth of the core Cognizant business?
Well, it implies the organic growth is much lower, probably somewhere in the 2–3% range, which is, better than the stagnation they saw before, but it's not exactly stellar growth yet.
Hmm.
It reinforces that the recovery is still very much in its early innings.
Okay, that raises a key question then. If the core organic growth is still kind of stuck in low single digits, why should we believe that this big billion-dollar AI investment is suddenly going to hit the accelerator? What's the bridge from 2–3% organic growth today to, say, the high single-digit growth they need to really impress the market? What has to happen?
That's the crux of the execution challenge. Management's argument, essentially, is that the acceleration will kick in more visibly in the second half of 2025 and beyond. It's predicated on two things happening. First, those huge AI-related deals they've been booking, those multi-hundred million, even billion-dollar contracts, need to start converting into recognized revenue at scale. There's always a lag between booking a deal and actually delivering the work and getting paid for it.
Right. Bookings are promises, revenue is reality.
Precisely. Second, the overall mix of their revenue needs to shift more decisively towards those higher value, higher price consulting and implementation services tied to neuro AI and other strategic areas. They're effectively trying to trade up, do less of the lower margin legacy work and more of the higher margin future-focused work. But that transition takes time to flow through to the reported organic growth numbers.
So it's still very much a show-me story on the organic growth front, which makes their competitive advantage, their economic moat, really important. Is this just a commodity service they're selling, easily swapped out, or do they have something defensible?
Definitely not a commodity. In this kind of professional services business, things like brand, trust, reputation, and especially deep human expertise are absolutely critical differentiators. You could argue Cognizant's most valuable assets aren't even fully captured on the balance sheet. We're talking about the collective know-how and industry-specific skills of their, 343,800 employees? That's immense human capital. Plus the long-term relationships they've built with clients over decades and proprietary intellectual property like the Neuro AI platform itself.
And the switching costs must be pretty high for clients, too.
They are substantial. Think about it. These services often get deeply embedded into a client's core operations, their main banking systems, their healthcare claims processing, their manufacturing controls. Ripping out one service provider and plugging in another is usually a massive, costly, and risky undertaking. It can take months, even years.
So that integration creates stickiness.
Exactly. It creates a kind of narrow economic moat. It helps protect their existing revenue streams and gives them some degree of pricing power because clients are reluctant to switch unless there's a very compelling reason.
Okay, so strong strategy, solid financials, some evidence of execution, a narrow moat. But what are the big risks here? Where could this turnaround story derail?
Well, given the positive direction, the key question really becomes, can they execute consistently enough to realize the ambition? The major risks highlighted fall into two main buckets: external competition and internal talent dynamics.
Makes sense. Competition must be brutal.
Oh, it's relentless. They're constantly fighting against larger, deeper-pocketed firms like Accenture, who often have the ear of the CEO for the most strategic projects. But they also face intense competition from smaller, nimbler, specialized players who might dominate a specific niche, like cybersecurity or a particular cloud platform. The big risk here is if Cognizant doesn't innovate fast enough, particularly in AI where things are changing almost daily. If they fall behind the curve, they could easily lose market share in precisely those high-growth areas they're targeting. staying ahead is paramount.
And the internal risk. You mentioned talent earlier. That war for talent must be fierce, especially for people with Gen AI skills, cloud architecture skills, the very people they need to power this neuro AI platform.
It's incredibly fierce and expensive. The good news, as the sources indicate, is that they seem to be making real progress on their goal of becoming an employer of choice. That voluntary attrition rate, people choosing to leave, has come down significantly.
What were the numbers again?
It peaked at a really painful 25.6% back in 2022. That's more than a quarter of your workforce leaving voluntarily in a year. But by Q2 2025, they'd managed to get it down to 15.2%.
Okay, 15.2% is still quite high, but a huge improvement from 25%. That stability, it must be crucial for actually delivering on these big projects.
Absolutely necessary.
Yeah,
But,
yeah.
and this is the critical risk that ties everything together, there's the potential for a margin squeeze.
Margin squeeze.
Meaning the cost of that talent eats up the savings they're getting elsewhere. Remember, the whole point of the next-gen restructuring was to save money, create operational leverage, and expand margins. But if wage inflation keeps rising sharply, especially for those in-demand AI, cloud, and data science experts, they absolutely must attract and retain. Could those rising talent costs effectively cancel out the hard-won savings from next-gen?
Ah, I see. So they save $100 million from closing offices, but then have to spend an extra $100 million on higher salaries for AI experts just to stand still on margins.
That's the potential squeeze. If talent costs rise faster than they can generate efficiencies and leverage, they won't hit those crucial margin expansion targets.
Yeah.
So managing talent costs effectively becomes the ultimate balancing act that determines whether their profitability goals are achievable. It's the linchpin risk.
Okay, that makes sense. So execution risk, competitive pressure, and this potential talent cost margin squeeze. How is the market pricing all this in? Let's talk valuation.
Well, the valuation clearly shows the market is still applying a discount, reflecting the risks inherent in executing this turnaround. Cognizant is currently trading at a trailing 12-month price-to-earnings ratio, PE, of about 13.6x.
And how does that compare to the peers we mentioned?
It's a noticeable discount. Accenture trades closer to 20.3x PE, and a firm like TCS is up around 24.0x. So Cognizant is significantly cheaper on that basis.
So the market's basically saying, we see the plan, but we need more proof it's working consistently before we give you a higher multiple.
That's essentially it. The valuation gap exists because investors are waiting for sustained evidence that Cognizant can successfully execute the internal transformation and close that growth and profitability gap relative to its peers.
Okay, so the materials lay out a few scenarios, which is helpful for you, the listener, to map out what needs to happen for that valuation gap to potentially close. Let's run through those. First, the base case. What does that look like?
The base case assumes management basically delivers on the core plan, but maybe without shooting the lights out. They hit their guidance. Total revenue growth somewhere in the 4–6% range. That's likely a mix of continued M&A contribution plus a slow, steady improvement in organic growth. And critically, they achieve modest margin expansion, maybe 20 to 40 basis points per year. If they deliver that consistently, it de-risks the story enough to justify the valuation multiple gradually improving, narrowing the gap somewhat. The target price mentioned in this scenario is around $84.
Okay, $84 for steady execution. What about the upside, the bull case?
The bull case is where the AI strategy really pays off, and faster than expected. In this scenario, that billion-dollar investment translates into a wave of big new contracts, pushing organic growth up into the high single digits much more quickly. And just as importantly, the cost savings from next-gen combine powerfully with strong operating leverage from that higher growth, causing margin expansion to significantly beat the guidance. Maybe they get 50, 60, 70 basis points of expansion or more.
So faster growth and faster margin improvement.
Exactly. That's the scenario where the market fully buys into the transformation story and starts valuing Cognizant much closer to its peers, maybe like Accenture. The price target associated with this outcome is around $100.
Okay, $100 if everything clicks in the downside. The bear case.
The bear case is basically execution failure. Maybe a sharp economic downturn hits, stalling organic growth completely, keeping it below that 2–3% level, or even turning negative again. And critically, in this scenario, that margin squeeze we talked about becomes reality. The high cost of attracting and retaining AI talent completely wipes out any savings from next-gen. Margins stagnate, or maybe even compress. If that happens, the market would likely lose faith in the turnaround, punish the stock, and the valuation multiple could contract even further. The price target here is pegged around $65.
$65 if things go wrong. Okay, base, bull, bear, that maps it out pretty clearly. So wrapping this up, what's the big picture takeaway from this deep dive?
Well, the materials really paint a picture of a turnaround that's being driven primarily by deliberate internal actions. It's the new leadership, it's the concrete steps to the next-gen efficiency program, and it's that very strategic, very large billion-dollar bet on AI. This doesn't feel like a company just drifting along hoping the market lifts them. They're
Yeah.
actively trying to reshape their own destiny.
And the direction seems right. Targeting AI, ER&D, platform integration, those look like the right places to be.
Strategically, yes. The alignment with major growth trends is sound. The balance sheet provides a really important safety net while they navigate these changes. And, as we discussed, for investors who believe management can execute, the current valuation offers a potentially attractive entry point precisely because the market isn't fully pricing in success yet. It hinges on execution, closing that gap with peers.
Okay. So a credible turnaround story, but with significant execution hurdles still ahead.
That sums it up well. Which leads to a final thought for you to consider. We talked about how human capital, the expertise of those 343,800 employees, is arguably Cognizant's most valuable yet intangible asset. The success of that whole billion-dollar neuro AI platform ultimately rests on the skills and dedication of those people. Now connect that to the bigger picture. The ultimate test of this huge AI investment might not actually be the sophistication of the technology itself, or even the strength of the NVIDIA partnership. It might come down to whether Cognizant can keep that improved voluntary attrition rate, that 15.2%, from creeping back up again. Can they manage the intense competition for talent well enough to protect the margin expansion they desperately need to pay for that very talent? So here's the provocative question for you to chew on. Which force ultimately holds more sway over Cognizant's future? Is it the breakneck speed of technological innovation that fuels their AI offerings? Or is it the relentless, costly, and very human competition for the expertise needed to deliver those offerings and maintain profitability? Tech innovation versus the talent war. Something to think about as you continue your own deep dive.